Hello and welcome to Chapter 14. Chapter 14, we're going to talk about cost behavior and how cost behavior works within an organization. We're going to talk about three basic costs: fixed cost, variable cost, and mixed cost. In this chapter, we're going to cover the differences between cost behavior, and we're going to define fixed and variable cost. Look at, define and describe what mixed and step costs are, uh, and then we're going to talk about separating mixed costs between fixed and variable components. We're going to use the high-low method, the scatter graph method, and also the method of least squares. Each has different characteristics, but they're all used to create a cost model. Basics of cost behavior. Cost behavior is the foundation of managerial accounting. If you remember from the last discussion, what we found is that we looked at what it costs to produce something or deliver a service, particularly the cost to produce something, and that goes into cost of goods sold. And that cost is used for multiple things. It's used to evaluate a selling price, determine a selling price, but it's also used to value inventory. And costs can be variable, fixed, or mixed, and we'll talk about those here in a little bit. A fixed cost doesn't change no matter the amount of output. So look at that like, say, a supervisor's salary or depreciation expense or property taxes. No matter what happens, it does not change, irrespective of the volume of output that an organization has. Remember, and one thing you might think about is that's an awful lot like manufacturing overhead that we discussed in the last section. Variable cost increases as total output increases and decreases. Correspondingly, typically this is going to be established on a per unit basis, say $2 per unit of output. So your cost equation, if you wanted to look at this, is you're going to have a fixed cost plus a variable cost, say $2 times X, where X is a unit of output. And that's going to give you your total cost equation. And knowing these costs can help you determine how to plan, control, and to make decision making for an organization. All these costs are within a relevant range, and we'll touch on that in just a minute with the graph. But the relevant range is curvilinear on the tails, but in the middle is generally linear. And what that means is typically it's going to be 20 to 80% of capacity. It's going to be the relevant range. In other words, if you're way at the low end, your costs are going to go up. In other words, less than 20%, or if you're way at the high end, if you're 80% or more. Well, there's a cost driver that impacts that. And and what you want to do is you try and manage those cost drivers based off of that, which might be a unit of output. It could be plenty of other things as well if we're just looking at a total cost to produce something or deliver a service. So here's what I was talking about with the relevant range. You see where it's curvilinear. It's curved on the tails, and it's linear in the middle in the relevant range. So the assumption here we're doing is we're dealing with outputs within the relevant range. Once you get on either side of this, something happens where cost changes drastically. And you notice on the graph your cost goes up as volume goes up. So this is 0 at volume, this maybe is 100 on the scale, and this is 0 and 100. So cost goes up as volume goes up. Now, if we have fixed costs, this is kind of an interesting look. And you notice here, this is the cost that we're looking at. The total cost of supervision, irrespective of how many units you produce, remains constant. It's at 32,000 in each case. But you notice the unit costs change as we produce more and more because you're taking the 32 and dividing it by the divisor, and it's going to come up with different costs for each level of output. Okay, that's fixed cost. And here's a graph of fixed cost. You notice it's a straight line all the way across, no matter what. Irrespective of the output, the fixed costs remain exactly the same. Now, we have two different types of fixed costs. You have discretionary fixed costs and committed fixed costs. And you say, well, why is that important? It's important for a couple of different reasons. Discretionary fixed costs are things that you might be able to change or avoid based off of management discretion. Maybe they have three supervisors, but they could eliminate one position and it would still work, but maybe not as good. Committed fixed costs are things they cannot change easily, like a lease cost or depreciation cost. You can't really change that a whole lot. You're stuck with whatever it is. Property taxes is a prime example of committed fixed costs no matter what you do. And why does this matter? Because if, for example, you elected to close a manufacturing facility or a company, Some of these costs, sometimes they might use these avoidable fixed costs and unavoidable fixed costs. And we'll touch on that, some of that a little bit later, hopefully in the semester. But really, what that means is if you close something, there's avoidable fixed costs that you don't have to pay, but there's unavoidable ones that you're still going to have to pay. So how do you understand that? Well, if you think about a supervisor, if you close a manufacturing facility, that supervisor goes away. That's discretionary. If you still own the facility and you haven't sold it, you have certain committed fixed costs that you're going to have to pay to maintain that facility until such time as you reopen it or you sell it. Variable costs, on the other hand, or by contrast, are really expressed on a cost per unit basis. And you notice here what happens? It's a cost per unit, and the cost per unit, so we look at this graph on the right, the cost per unit is $20 per unit no matter what, so long as you're within the relevant range. But here's what happens. As volume increases, it's a proportional increase in costs. So you get these costs. So you have 7,500 and you have 150,000. So it says that you have $150,000 worth of cost, which is $20 per unit times the 7,500, etc. You can follow what happens. So it's really a variable rate times the output is equal to total variable cost. So if you want to look at it, here's how the cost relationship works. But you have to be careful. Remember, you are in the relevant range. So they're semi-variable within the relevant range. A straight cost can be the same within the relevant range, but once you get outside of it, it changes drastically. Why is that? For multiple reasons. And we'll touch on some of those here shortly. Mixed cost or total cost is really total fixed plus total variable equals total cost. And that's going to be a mixed cost. So here's a line, and you can tell right here where that data point is. At zero, the difference between zero and this number, which is about $750, maybe $850, is constant. So what that tells you is that your fixed cost is that much money, and the rest of this stuff, as the volume goes up, your total cost goes up, and it's pretty much on a linear basis. And they drew this line in, but we can create a formula with that using three different methods. We're going to use the high-low method, we're going to use the least squared regression, and we're going to use a scatter graph. Now, step cost, and a step cost, you notice these are narrow steps, which means as you increase the number of units, your costs jump up drastically. So depending upon what you're doing, your costs can jump up drastically for multiple reasons for that as well. And I can't think of a good example right now, but if you have a narrow step, typically that's not going to be adding, say, a new production line. What it might be is that you have to add a new maintenance person as you increase the number of units that you produce, and that maintenance person is going to be there no matter what. So you're adding a new person as you add more and more different types of production, or you might have some specialized piece of equipment that you need each time you add new products. But you notice that the line is steeper and the steps are steeper. Now, if you have a wider steps, that might be where you're adding. Maybe you're an organization, you only have a 1 6-hour shift, and then when you add a second shift, maybe you add another supervisor. If you have a third shift, you add another supervisor, another 6-hour shift, and a fourth one, you add another 6-hour shift. So you're stepping up each time, and your number as the number of units produced goes along. So that's kind of another example. So it says here, for example, they have a leasing of machinery. As they lease more machinery, you're going to have step costs in order to do that. That's a much wider step. Um, so why do we do this? We separate these costs. Remember, the goal of management accounting is to separate the costs in order for decision-making purposes. And we want to be able to understand what costs are what costs are cost drivers. And you notice here, if mixed costs are a small percentage of total cost, former cost separation is not worth the effort. And sometimes you have to look at a cost benefit within an organization to determine if you want to isolate individual costs. Typically, you do not. And and you notice another thing is you can arbitrarily divide mixed costs. So what happens is some of that becomes at management discretion. Um, and So what we're going to do is we're going to look at how to calculate different types of costs. We're going to use a high-low method and a scatter graph, and then we're going to use the least squares. In each method is an assumption. The assumption here is that there's a linear cost relationship. So really what we're doing is we are going to use a basic calculation to draw a cost line that we saw earlier. Remember where we looked at that one that had 850 as a fixed cost, and then the other costs were variable. Well, we're going to do a total cost equation for that. So, so here's what our total cost equation is going to look like. Total cost is going to be fixed cost. That's going to be like a pure dollar amount. Say like in our initial example, I think it was $32,000. Then the variable cost, this is going to be a rate per unit times a unit. And that's going to tell us our total fixed cost. You can read through all this stuff, but what this is really saying is if I'm making chairs, let's say, for example, the variable rate is really direct materials and direct labor per chair is say $45. Well, that's going to be 45, and the output is the number of chairs that I produced. And if I have one supervisor on that line, say that he supervises and it costs the company 32,000, that's going to be our cost equation. The only thing we really need to know then is what this output is. And this variable rate, we'll learn how to calculate that. But that's what cost accountants do typically. They look at all this stuff to try and figure out as part of management accounting. They use this to try and figure out what it's going to cost a company to manufacture a product and that sort of stuff. And where the line intercepts on the edge of the graph at zero production, that's where your fixed cost, and then the slope is a variable cost per unit. So here's an example. I'm not going to go through all this with you, but you can kind of see what happens here. We already know. Let's start at the top. It says it has the department has purchased it. So it says the monthly depreciation is 250. So that's going to be our fixed cost. And there's paper of 10,000 sheets, 20 reams, $35 per box, and ink cartridges, and we'll print on average 300 pages. So what we want to do is we want to look at the number of pages. So we can do some division here to figure this out. So we know that we have 20 reams of paper, so we have 10,000 sheets of paper at $35. So we know per sheet is going to be what, three and a half cents? No, actually 3.5 cents. And then we have the ink is going to be 10 cents. So it's going to be 0.10010. Add these two together, and that's going to be the variable rate, and the fixed rate is going to be the 250. And then you're going to put in here 4,400 pages, and it's going to calculate out your total cost. So here's the calculation. The variable rate per page, that 0.0035, which is for the paper, plus 10 cents for the toner is 1035. And then here's your formula, 250 plus 1035 times 4,400. And that's what our expected fixed cost is. And here's what it's going to cost us for the next month. 250 plus 4455.40 gets you 705.40. The high-low method, what we're going to do with the high-low method is a little bit different. We're going to take the high dollars and the low dollars, and we're going to look at the difference between those. So we're going to look at the high dollars, which it looks to me like it's 7,500 and 500. And we look at the low, and it's 1,900 and 200. And we're going to take these and look at the difference between those. And we're going to look at the difference between the costs. So we're basically trying to approximate that formula that we had in order to get an idea of what happens. So let's take a look. We look at the high point and the low point, and we calculate the cost difference between the high and the low, and divide it by the unit difference between the high and the low, and that gives us what our variable rate is. Then we take that and we plug it in based off of the units, and we can come back and back into the fixed cost. So what we're going to do is we're going to take this rate, plug it into this, take the output at the high and put that in, and then we have the total cost from the high point, and it's going to tell us what our fixed cost is. We're going to basically back into the fixed cost. So let's use this as an example here, where our high point looks to be 4,100 at 600 machine hours, and our low point looks to be 2,575 and 350 machine hours. So we have those two, no, 4,200, I take that back, 4,200 and 590 and 2,575 and 350. So we're looking at the differences between those two. The dollars, 4,200, the dollars will be 2,575 and 4,200. So we're looking at the difference between those two. Then we're looking at the difference between the units, which is 240. So we're going to take 4,200 less this, which would be 1625 divided by 140, which is 240, which is the difference between those two. And let's take a look. So 1525 divided by 250 gets us 610 per machine hour. Now we're just plugging in the 610 here, and we're using the 600 machine hours, and we have the total cost, which we know is 4,100. That's going to tell us what the fixed cost is. So here's the total cost at the level of 600 machine hours, and you have $6.10 as your variable cost. 600 machine hours again, so it tells us the fixed cost is 440. And then we take that 440, so now our formula is going to be 610x, which is going to be the machine hours, plus 440 equals total cost. So there's our formula down here. And we can check it and make certain it's right. So what we're really doing with this high-low method is we're generating a line, a formula that fits two data points on the line. And of course, you're going to have data points that are going to fall off of that line, but that's all you're really doing. You're fixing the point where it crosses the x-axis or the y-axis, excuse me. That's the 440 fixed cost, and then the 610 is variable if you looked at our graph. And so there's the solution, and then we can put in there based off of the number of machine hours, we can make a calculation. You might want to pause this slide and look at this. I don't know that I need to read through it. And here's a little bit more from the same thing. And same thing if we do the high-low method, we can do the exact same stuff. But now what we're going to do is we're going to look at it for a year as opposed to a month. And so if the fixed costs are 610 and we know the total units for the year is this, we can calculate for a year what the estimated electricity cost is for this particular business. Okay. Now we're going to do another way to look at this is from a scatter graph. In the scatter graph, these are just all the data points that we've put on. In the high-low method, we did a line, a graph that did this, these points, and then you can do this by visual. So each one of these has different is a look. This is the scatter graph method. This is a scatter graph with high-low, and then this is just by visual. So you're just drawing a line, eyeballing it, if you will. Each one of them kind of gives you the same um, take at the data, and you can justify the elimination and lead to better estimate by the underlying cost function. The high-low method gives you a better, if it's better points, if we can look at those, are they good data points? Because maybe they're not. Maybe the slope of the line should be more like this than what it is in this graph. And it's the variable cost. And then the scatter graph is just another way of looking at it. And an infinite number of lines can go through the data point. So you can kind of see what happens here. So all we're doing is trying to estimate based off of this. And you can look at this scatter graph and say, for example, you look at 0. Well, you know your fixed cost is going to be about $1,000, and then your variable rate is going to be 12. So this is 800. So you're 800, and then you can tell that it's 12, because if we go to the next data point, it's 2,000. 800 here and 2,000. So we look at the difference. So it's very, very similar to, it's basically actually like a high point, but you're doing it visually with the graph. And now there's the formula. Very similar. It looks just the same as the high-low method, but now it's a total cost formula with 800 and 4,200. But it's really dependent upon the data. Now you notice the least square method is just one that you can do with this. It gives you a closer approximation. And you can run this really through Excel. And I'm not going to go through the Excel model, but that's just another way to come up with the formula for costs. And it looks at the line deviations from this, but ultimately it gives you a line that runs through all this data. This one's interesting and implies that there's no fixed cost, which doesn't make sense because you know that there is. But here's you can use the same data we used earlier, but we're going to use but it already gives us the coefficients. And this one is the fixed cost, and that's the variable cost. So it's a little bit different than what we saw earlier. I think we had 350 and 650, if I remember correctly. So this is a little bit closer approximation, but it's not the same. So there's a little bit of difference between them. And if it's really important that you have the right cost formula, you might want to use this. Okay. And here's the total electricity cost. So it's very similar to what we saw for a month. But the difference is each one of these is a little bit finer than what we saw. And you're running this really through an Excel model to do this, to give you, and really you want to know what's important with all these is you want to know how to control costs and what are the drivers, irrespective of what volume you use or what model you use. You have to you're going to need to know the costs because you can separate those costs and determine what decisions you can make in order to affect the costs. Because that's really what you're trying to do. And I like this where it says decision making. Most models would actually say planning, controlling, and directing. They wouldn't say decision making. And decision making is based off of good data. What does it make sense? There's an old model that used to say garbage in, garbage out when it talked about computers. I think it's really the same way when you're doing cost estimation, optimization. Garbage in, garbage out. So you can look at each one of these. I'll let you stop the slide and review these. But what's really probably happening most of the time in the real world when you're doing cost estimation like this is you're going to look at what you did last year, and depending upon what cost you're looking at, will make a difference. If it's say for example a utility, they're probably going to say what was our kilowatt usage last year. And they're going to look at some drivers based off of that, like the weather, for example. If you're running an air conditioner, what does it mean? Well, last summer we had 90 days over 95 degrees, and the year before that we only had 30. So the difference might be just driven by that, or it could also be rate as well. So there's multiple other ways to analyze these costs besides this. And but the thing that's kind of interesting with anything that you're doing here, management judgment or managerial judgment impacts what decisions are made and how they're made. Because remember, if you're a managerial accountant, one of the things you're looking at is actual versus budget. And what managers want to do is they want to realistically have their budget as high as possible because they might get incented on beating their budgeted number. So whatever proposition they can sell, particularly if they're in a manufacturing facility, they're going to do that because if they don't, they're not going to want to be aggressive and say, well, last year I spent 1,000, and this year I only think I'm going to spend 900. They're going to say, no, last year I spent 1,000, and this year I'm going to spend 1,100. The reason they want to do that is because if they get a bonus or their pay is based off of that or the performance is based off of that, they want to basically sandbag or pretend like the number is higher than it is. So they're trying to play a game with it as well. So they might do things differently than what you would want them to do. And you just have more of those kind of things with estimation. You can read through all this stuff, but that's really what it boils down is management has judgment over what they're doing in their numbers, and they're influenced by certain things that happen within their cost equation to determine what they're going to do as an organization. When we get to the next chapter, we're going to talk a little bit more about some of this cost, but what we're going to do is we're going to change our equation where we have total cost. What we're actually going to have is sales revenue, and the variable is still going to be that X in the number of units. So what that's going to do is we're going to now calculate something called break even and something called cost volume profit analysis. But let's touch just a second before we get there on the ethical implications of management judgment. They use their judgment to do this stuff, but they're trying to do it with the best information possible. But really, they also have to think about what's most important for them, and sometimes it's not the same as what it is for the organization. And so you have to be mindful of that as a management accountant. Or if you're not going to be a management accountant, you can understand why, if you're in a position to give budget estimates, that the management accountant is going to ask you typical questions to make certain that what you're providing him is realistic relative to the organization and what the organization is going to do. And that's all what I would call the budget dance. And there's some what's the right word? There is some discretion in what happens in the budget dance, and people are going to try and sell what they can sell within that dance in order to what's in their best interest. That's the end of chapter 14. I look forward to seeing you again in chapter 15. I hope you have a great day. Thanks.